My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job, it's not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. You know what's driving me nuts about this market? We've just got too many disparate metrics to keep track of, too many weird goalposts to watch. And after a day where the Dow gained 15 points, S&P dropped 0.01%, NASDAQ gave up 0.06%, I think all these strange non-earnings per share metrics are making the action a lot harder to understand. What do I mean by weird metrics? So let's just go right to it. Case in point, the stock of Netflix, all right? I know you're thinking about that one. Here's a stock that has never traded on earnings per share, ever. There's just not the number anyone cares about. You'll never hear anyone come on here and say, hey, you know what, that Netflix is really cheap at 80 times earnings. No, Netflix trades on subscriber growth. As these things go, subscriber growth isn't too weird. I mean, that's a nice objective number. But once you start evaluating a stock on something other than sales or earnings, you open the floodgates to all sorts of other metrics. So it's not just subscribers. Netflix also trades on FOMO per share. That's fear of missing out, as in the subscriber count is driven by the fear that you'll miss out on great content. In a world where Netflix trades on FOMO per share, that means the Emmys matter. But Netflix did just okay at the Emmys. There wasn't anything that made people say, like, you know what, wow, I am missing out. I see all those awards. I'm missing out on too much content. I gotta sign up. And that's why the stock got hit today. Or how about a couple of tech titans like Facebook and Alphabet? If these stocks were simply judged by their earnings per share, they'd be a heck of a lot higher because both companies are doing incredibly well. They're two of the cheapest large cap stocks in the entire stock market. But the thing is, they don't just trade on earnings. No, what really matters to both of these stocks? For both Facebook and Alphabet, the answer is investigations per share, because we know that the government is coming after them. This morning, Snap, the parent of Snapchat, revealed something called Project Voldemort. How about like Operation Potter? I don't know. Project Voldemort, equating Facebook to the Harry Potter villain, where they've been keeping track of all the nefarious things that the competitor's done. Now, we know the FTC, the Federal Trade Commission, is looking into everything about Facebook. So word about Snap's slam book caused the stock to get hit down more than $3 today. See, I would tell you it's a buy, and I do like it. My Chappell's is a big position. But then what happens? We get another investigation per share announcement tomorrow. Stock goes down. Meanwhile, we know Alphabet is under investigation by a group of states' attorney generals for anti-competitive practices. But the stock acted better today because there was at least no news. This was no investigation per share day for Alphabet. Tough luck for Facebook. Then there's Johnson & Johnson. Do you know that this is one of the greatest companies on earth? It's one of only two corporations with a AAA balance sheet, other being Microsoft. Got a fabulous pipeline of drugs, high organic growth, terrific management in Alex Gorski. None of that matters. The stock has been a total dog because J&J now trades on lawsuits per share. They're gripped by the opioid and tax stories, and everybody's worried about the kind of settlements they may have to pay out and the big judgments occurring. And, you know, when I hear about J&J, what do I hear now? Oh, there's a trial that's about to start in blah, 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 Ohio. It's like, oh, Jesus. Who can own this stock through the lawsuits per share? We're seeing the same thing in McKesson, CVS, and, of course, the generic drug makers like Teva and Mylan, which have a lot more exposure to these opioid lawsuits. These stopped trading on earnings a long time ago. They go down every time there's a loss in court, not a loss in earnings. Who can analyze that? I mean, it's very tough to quantify. It's a nasty situation. Now, the tariffs are another story that's hard to put into numbers. This morning, Apple announced that they're planning to make the new Mac Pro in Austin, Texas. And in return, they get a waiver for the parts they're importing from China. Well, that's a huge win. But it's the kind of thing where it's impossible to game. We don't know what the tariffs were for these components. We don't know how much the waivers are worth to Apple. We just know that it's positive. Is that why semiconductor players like Intel, NVIDIA, XP, Micron broke on the day rally today? Was that what it was? Did it breathe new life into semiconductor capital equipment makers like Applied Materials and Lam? How do you put a price-to-earnings multiple on this new way to avoid the president's tariffs? That could result in a wholesale revaluation for the whole sector, so investors will pay up for the chip makers, at least until something new derails the trade negotiations with China. And maybe it's the idea of what did happen in Montana. Maybe we need to investigate about what happened in Montana with the farmers. I mean, come on, how about the railroads?
All aboard!
These stocks used to be measured by the freight loads, how they were doing, which translated directly into earnings. Not anymore. They trade on execution. I'm talking about precision railroading, keeping better track of where all their cars are so they can charge higher prices and don't have to give too many discounts. You need to know these numbers if you're going to invest in the rails, or else. All right, then there's aerospace. We know nothing is more important to this industry than getting that Boeing 737 MAX back in the sky. Periodically, Boeing stock will get hit by negative publicity. Can you recall a single positive story about this company in ages? But I think it's worth hanging in there, waiting for the FAA to give them approval, because there's so much demand for aircraft that the stock will take off like a rocket when that happens. And those are just the tip of the iceberg. I have another dozen examples in my head, a dozen examples of stocks that simply don't trade on earnings or sales anymore. When there are only a few of these names, it was fine. But these days, there are so many of them that it's become much harder to parse what's going on in the broader market. We like earnings per share. We like revenues. But this, all these new investigations per share, hard to get your arms around. Now, what do you do if you're hostage to one of these odd metrics? First, I think it's only safe to own one or two of these, because if you have too many of them in your portfolio, it's going to drive you crazy. Second, if you want stocks that are more straightforward, you can always buy some dividend names with big yields, the ATTs of the world. They'll let you sleep at night. The important thing is that you know how much agita you're willing to put up with. It's called suitability. It's much easier to own a dividend stock than something that trades on federal investigations per share. I'm not saying you shouldn't own these stocks with non-traditional valuation metrics, but it requires more patience than owning something normal. And you pick up the paper, and you're in the paper every day. Finally, and this is the big one, you have to be skeptical of markets, entire markets, where more and more stocks are valued on something other than earnings. This is what happened during the dot-com crash. You had tons of companies that were trading on eyeballs and page clicks. Needless to say, that suspension of rigor did not end well. The more stocks that trade on weird metrics, the more likely it is that the market's overvalued. Right now, I still think the bulls have the upper hand. They're winning September for once. But here's the thing. You can only go up for so long based on something other than earnings before we have to accept that valuations have gotten out of whack. In other words, this is not a normal market, so we do need to be careful. At least we don't have to worry right now about WeWork. Yeah, because apparently that one's about tequila per share, judging by how much tequila flowed in the office when CEO slash King Adam Newman was on top of his game. But with 9 investment bankers in the running the books and being on the hooks, you better believe they'll find a way to get that metric in front of us. The bottom line, when we had only a few stocks that were traded on something beyond the 4 walls of the spreadsheet, well, that was fine. But when you have dozens of stocks, including entire sectors, that have become partially unhinged from their sales or earnings, well, I have to tell you, you got to proceed with caution. Let's go to Rodney in Tennessee, please. Rodney.
Hi, Jim. Rita and I thank you for taking our call.
Of course. Thank you.
Good. I bought Oracle, and I thought it was oversold on bad news. I've made money on this trade. The question is, should I keep it?
Well, there was some discord on the call because we don't know exactly what's wrong with Mark Hurd, co-CEO, but he wasn't on the call. And he's a man who has driven a lot of sales there. So I'm going to have to say, you got to hold off until we know more. We lack information about what's going on at Oracle. Let's go to Gary in Mississippi. Gary.
Hi, Jim. Good afternoon. Pleasure talking with you. Have some Pfizer stock. And with all talk of the government getting into healthcare and pharmacies, want to know if, and pushing drug prices down, want to know if Pfizer was big and diverse enough to handle that, or will it start to have an effect on them in the long run?
Well, look, they are, and it yields 4%, but it's down 17% for the year. Why? Because it has no growth. I prefer AbbVie. AbbVie's got yield, and AbbVie's got a merger that's going to be very good. That's the one you should be in. All right, some stocks have just become unquantifiable. They don't trade with earnings or sales, and that's why they're often difficult to assess. There's too many metrics. Oh, man, money tonight. It's been a wild summer for Canopy Growth, to say the least. The company's remaining CEO talks to me for the first time tonight about the cannabis company shakeup and what's ahead for the stock. Then, how the latest IPO cycle is taking its cues from Bob Dylan. It ain't me, babe. And with all the action in the oil patch, wondering what's ahead for the commodity? I'm talking to one of the smartest guys in the business, if not the smartest. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.